Gold is trading at $5,092 per ounce right now. The dollar index is at 100.17. The 10-year Treasury yield just hit 4.24%. Three numbers, one enormous contradiction. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold has given back every single dollar of its war premium gains since February 28th. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. The U.S. Federal Reserve and the U.S.-Iran conflict are operating simultaneously. Gold's intraday range today is $5,072 to $5,128. That is a 56erd range on a Friday. Silver is ranging from $83.98 to $86.54. That is a $2.56 range in a single session. The dollar index, DXY, is at 100.17, up 0.44% on the day. This is its second consecutive weekly gain. The 10-year Treasury yield closed Thursday at 4.24%, a 5-week high. The Fed meets March 18th. Markets are pricing a hold at 95.6% probability per CME FedWatch data. One 25 basis point cut is now priced, pushed all the way to September 2026. The timing is what deserves scrutiny, not the event itself, the timing. The same conflict driving safe haven demand for gold is simultaneously strengthening the dollar and pushing yields higher. Think about what that sequence actually means. Two forces pulling gold in opposite directions at the same time. That is not coincidence. That is the structural paradox that defines this market right now. Before I show you the full data picture, consider this. Gold is up over 22% year to date before the Iran conflict even began. It was already running. The war did not create this bull market. It accelerated it. And now, the same war is the primary headwind. The data is doing the talking. Let's build it out. Now let's build the full picture because the dollar-gold relationship does not exist in a vacuum. The US dollar index, sourced directly from the ICE exchange, is printing 100.17. The mechanical inverse relationship between gold and the dollar is one of the most consistent patterns in modern market history. When the DXY rises, dollar-denominated gold faces direct pricing pressure regardless of underlying demand. That is arithmetic, not opinion. The 10-year Treasury yield at 4.24%, sourced from the U.S. Treasury Department's official daily yield curve, represents the real yield compression mechanism that institutional desks model against gold. Higher real yields increase the opportunity cost of holding non-yielding bullion. That is the textbook relationship, and it is functioning exactly as textbooks describe right now. The Shanghai Gold Exchange benchmark, SGE, is trading near COMEX parity in USD converted terms today. No material premium is visible on the SGE gold side. That tells you Chinese physical gold demand is not running at the acute premium levels that characterized Q4 2025's record central bank buying. The rate of premium compression from those Q4 highs is notable. The ones paying attention already know what that shift means for near-term price support. And here is what makes that picture even harder to ignore. COMEX gold open interest is elevated. The futures curve is in Contango, meaning futures prices sit above spot, reflecting standard storage and financing costs. No backwardation signal is present in gold. That is a structurally different picture from silver, where registered COMEX stocks have declined 23.1% in 30 days, and the coverage ratio sits at 13.6%. Gold's structure is under tension. Silver's structure is under stress. Those are not the same thing. And before anyone takes that as a green light in either direction, setups take time. The structural picture and the timing are completely separate questions. Anyone who claims to know the timing is selling something. Now the macro variable, because the US-Iran conflict is no longer a backdrop, it is the primary variable. Here is the number most people are not talking about. Approximately 21 million barrels of oil per day flow through the Strait of Hormuz. That is roughly 20% of global oil supply through one choke point. The IEA has approved a release of 400 million barrels from strategic reserves, its largest coordinated release ever. Oil is currently trading near $88 to $90 per barrel. Tehran and Washington are both issuing defiant statements as of March 13th. The Fed meets in 5 days. Markets are pricing oil-driven inflation as a reason to hold rates. Look at that sequence and tell me what probability you put on a clean de-escalation before March 18th. When markets start pricing the reality of what sustained $90 oil and a closed straight actually means. Gold reprices up on inflation fear. The dollar reprices up on safe haven flow, and those two forces remain in direct conflict. That is the historical pattern every time a major geopolitical supply shock has intersected with a tightening Fed cycle. It has not been different yet. Gold Western spot at 5,092s. Shanghai Gold, SGE, near COMEX parity. No material USD premium on gold today. Silver Western spot at 86 or 32ers. COMEX front month silver futures at 86.96, down 2.94% this session. Shanghai physical silver carrying a $4 to $8 per ounce structural premium over COMEX, driven by China's mandatory 13% VAT on silver imports. The short-term picture on gold is binary. The $5,050 to $5,072 zone is the current structural floor based on this week's price action. If that level holds into the March 18th Fed meeting and the dot plot signals even modest dovish accommodation, gold rebids toward $5,200 and then $5,400 resistance. If the DXY extends above 101 and the Fed's dot plot removes the September cut, gold tests $5,000. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does tomorrow. Nobody can. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. DXY at 100.17 is a direct mechanical headwind for dollar-priced gold. The 10-year yield at 4.24%, a 5-week high, increases the real cost of holding non-yielding bullion. The IEA's 400 million barrel reserve release, if successful, caps oil and removes the inflation premium from gold pricing. The bull case is equally real. Gold is up 22% year-to-date before the Iran conflict began. The underlying structural bid is institutional and central bank driven. The SGE COMEX parity in gold coexists with a persistent $4 to $8 premium in silver, signaling that physical demand pressure has not disappeared, only rotated. JP Morgan has a $6,300 per ounce year-end 2026 target. Deutsche Bank is at $6,000, both published by institutions with direct access to positioning data that retail does not see. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure in precious metals is already built. The dollar-gold paradox is not a new phenomenon, but the speed at which it is playing out against a live geopolitical event with a Fed meeting in 5 days is what makes this moment unusual. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. Don't take my word for it. Verify every number I gave you today. Check the U.S. Treasury's official daily yield curve at home, treasury.gov. Check the ICE DXY index at theice.com. Check the CME FedWatch tool at cmegroup.com. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones who verify don't argue about it. OG John AG 1.0, out.